Good morning, and welcome to the 7th Annual Commercial Real Estate Leadership Webinar. On behalf of myself, Leah Chrisman, conference producer, Linda Chrisman, owner of the Mid-Atlantic Real Estate Journal, and Ronald Shapiro, producer of today's event, we would like to thank you all for joining us this morning. As you may know, the Mid-Atlantic Real Estate Journal is a commercial real estate trade and print digital publication. Publishing twice a month, we have a readership of over 25,000 industry professionals throughout the Mid-Atlantic region. If you're interested in learning more, please contact me directly. I would like to thank our sponsors for today's event. Without their generous support, this conference would not be possible. Thank you to our silver sponsors, JLL and Spencer Savings Bank, and our corporate level sponsors, Verus, KeyBank, and Immigrant Mortgage. I would like to introduce the moderator of today's event, Ronald Shapiro. Ron is the Assistant Professor of Professional Practice, Finance and Economic Department at Rutgers Business School. He teaches real estate finance, investment, and financial management courses on the New Brunswick campuses. Prior to Rutgers Business School, Ron was Senior Vice President with Connect One Bank. If you have any questions throughout the webinar, please contact Ron directly. Now, please welcome Ron and his amazing speakers.
Thank you, Leah. Good morning, everyone, and thank you for joining us this morning. I would also like to mention as well that I'd like to thank the sponsors. Each sponsor I've known for many, many years, and they come to today's panel discussion with many, many years of experience. So let me give a brief background before I introduce Jose. The current economic crisis has created unprecedented economic difficulties for all real estate professionals. During the past 12 months, we have witnessed record unemployment, government paycheck protection programs, declining asset values, retail and hotel properties closing, increased vacancies, foreclosure actions having been halted, declining rents, as well as higher property operating expenses. Is there someone I've been thinking about who can make sense of all of this and tell us where we are and where we're headed? And the obvious answer is Jose Cruz, Senior Managing Director at JLL, is in fact the person who can help us understand the current state of the New Jersey real estate markets. Jose, it's all yours.
Wow, Ron, I appreciate that. Actually, I wish you were grading my exams when I was at Rutgers. I missed you by a couple of years, but no, listen, I appreciate it and excited to be here and talk a little bit about what we're seeing out there. And just to give you a sense, right, as we all know, the market from a commercial real estate perspective is evolving, right? It feels like whether it's every week or every month, things get just a little bit better. And if you'd have asked me in June, what are you going to be doing in March? I would have said nothing, right? But honestly, we're as busy as we were pre-COVID. And Lee, if you can go to the next page, just a quick 1 minute on the team. We have 19 professionals and we cover New Jersey, Connecticut, Long Island, Westchester, upstate New York, kind of the ring around New York City. And, you know, again, going back to middle of the summer, we were definitely concerned as to what was going to happen for the rest of the year and then going into 21. Transaction activity had really slowed. The buyer pool had gone relatively quiet. There was some activity on kind of net lease longer term credit deals, right? Everyone wanted that predictable cash flow, that stable NOI, and they were willing to pay for it in that time of kind of great uncertainty where no one knew kind of what was happening next. So if we go to we'll just go to the next page, but you know, one of the things that we saw and one of the first groups that I think to really, you know, kind of asset classes to really start to come out of the malaise and of some of the issues that we were seeing was multifamily and really industrial, right? Those were two of the groups or the groupings that I thought, you know, we would carry us out of what we were experiencing. And I will also say office and retail, I'm going to talk about each class here, but office and retail actually never went totally quiet. there was activity in those asset classes, despite the concern on retail and stores being closed, and the concern on office and people not being in occupancy. But the investors for those asset classes continued to invest there. And I'm going to talk a little bit about those. But I thought I'd start with multifamily because that really continued to accelerate in terms of cap rate compression. We saw a compression during COVID, from pre-COVID to post-COVID. And if I had to ballpark kind of how much of that cap rate compression, it was between 25 and 40 basis points of what we saw. Assets that we valued pre-COVID at a 4.5 were trading closer to a 4.1. Or assets that we valued at 4.75 were trading sub 4.5. So, and I'm going to go through some examples, but just a couple of trends that I thought were interesting to mention here. You know, we saw the suburbs really take hold during the pandemic, right? There was obviously a move away from Manhattan and the city and even the waterfront in New Jersey, right? That, I say emptied out, but occupancies dropped on the waterfront from kind of 92 to 95 to somewhere between 78 and 82. And it varied building by building, but I think on average, if we were looking at it, we did a couple of kind of, you know, market surveys at different points during the pandemic, and it really felt like that low 80s numbers where it settled for a while. I'm going to say once, you know, we got through the fall and into December and into early part of this year, the tide has started to turn. There has been more demand for the waterfront. And there's a lot of different reasons. If I think I had to classify it and pick one reason, is we're now a year into the pandemic. And, you know, those renters that came out of the urban areas, whether it was Jersey City or New York, and moved to the suburbs, their leases are now coming due. And they're starting to see rent increases of $100 a month, $150 a month, $200 a month. And they're looking at that saying, okay, look, at some point I'm going to have to go back to work in Manhattan or the waterfront, wherever I was working. And so I can either renew here in suburban New Jersey, Somerset, Morris County, wherever it is, and pay an extra $150 or $200 a month, or go back to my waterfront rental and get 2 months free, maybe 3. So that decision-making has now led occupancies on the waterfront to increase on the last survey we took to just about 90%, with some assets in the low 90s, 92, 93%. So we've seen a little bit of a shift. And with that, though, the suburbs have still stayed strong and they're still seeing great activity. And even for, you know, call it January and February, which are the last stats we have, we're normally occupancies, given it's the winter in the New York area, occupancies drop to kind of high 80s, low 90s from that 95, 96 range. We've seen them hold in the low 90s, which is great news. So a little bit of a move back to, at least starting to move back to the urban areas. But I'm also going to note, we haven't seen rents increase yet on the waterfront. So occupancies are up, but rents haven't moved. And just to highlight another kind of trend here, look, we have seen, there's definitely has been an increase over the last year in kind of non-payment from some of the tenants on the renter side for multifamily. With the eviction moratorium in place, it's made underwriting a little tougher for the investors, right? Not knowing how that's going to play out and when that's going to be lifted and when they can get income from those units. But that being said, we continue to see aggressive underwriting, and it's coming through in the cap rates, on the per unit pricing. And the last item here to talk about is rent growth. You know, if I'm looking at a timeline of kind of March to March, right, March 2020 to March 2021, I would have said, we'll just pick 2 points in time to make it easier, right? So sometime in the summer, rent growth for multifamily in the suburban New York area was basically no rent growth for 2021. Some investors actually underwrote negative rent growth for 21. Very, very limited rent growth for 22. Call that between 1 and 1.25%. But then strong rent growth for 23, kind of in the 3 to 4% range. And these are averages and kind of mixed conversations. And then very aggressive rent growth for 24 onward, assuming a full recovery of the economy. Fast forward to the first quarter of 21, and yes, now we're looking at still very limited rent growth for 21 in that 1 to 1.5% range. But 22 and onward, very aggressive rent growth in the 4 to 6% range. So as the economy's improved, the underwriting assumptions have improved. And that's been a theme that continues now. And also the bad debt expense that was being budgeted by a lot of the investors, where I would have said on average it was kind of 2 times the current numbers, is now back down to kind of the in-place bad debt expense. So some good underwriting and some improvements in multifamily underwriting. Let's go to the next slide. I just wanted to highlight a couple of deals that we're looking at that we're marketing. So we're about to come out with this 121 town apartments in Stamford, Connecticut. Deal size, call it 110 million. We expect institutional and private buyers to show up for that. The point at Fort Lee, deal size 170 million plus. Great response. That's in the market now. I think the interesting thing about that is the pricing on a per unit there, pushing north of 450 a door, is interesting, because I would have said pre-pandemic and maybe a year or two before that, there was a big focus on per unit pricing for multifamily, right? Your basis. How do I get out of this? If I'm getting in at 300 a door, can you get me out at 400? I think looking at today, and less of a concern on per unit pricing, because there is a focus on that rental increase. So that basis becomes not, I wouldn't say at the forefront of the concern list, right? Real estate taxes, fortunately, are at the forefront. Print House, Brook Place, a couple smaller deals, but nonetheless strong activity today. And it's again across the board. Even groups that historically have bought kind of core plus type assets where they need a renovation story, or Print House and Brook Place, you can see the delivery dates are kind of newer. Even the core plus buyers have a need and are looking at core assets, because you can underwrite these core assets today. I don't want to say with core plus underwriting, but pretty close, and enough to give you a lift if you have money to place. So we just got a bid on one of these assets from a 1031 buyer who, again, historically hadn't looked at newer product, but has a need. So the demand, both from an equity placement perspective to put money to work, as well as the cheap debt, is driving great activity on the multi side today. Let's check the next page. So a couple of other deals we're marketing right now. I think an interesting one to mention is this Prospect Place in Hackensack. We sold this about 4.5 years ago. It's now non-refundable. It's a private buyer. It's a great infill market in Hackensack. This property is a little unique in that it's a tower, but it also comes with a garden complex as well. And the pricing on this deal from a cap rate perspective, as I mentioned, we had priced this at about a 4.8 cap, and we're trading at sub 4.5. Again, kind of substantiating that drop in cap rates over the last 12 months. Although it's probably safer to say over the last 6 months, because the first 6 months of the pandemic, it was difficult to get comps and difficult to get data points. And that's one of the things we struggled with, was getting data points to support the pricing. But today, plenty of transaction activity. We closed about $1 billion in transactions in December, which put us kind of on par with what we were doing pre-pandemic in terms of total activity. Harbor Landing Apartments, Stamford, Connecticut. We're seeing a lot of activity in Stamford. Second asset I mentioned in Stamford. That one's closing this week, and that's a 4.6 cap at just over 350 a door. So again, good pricing, good activity. And the interesting thing about that one too is the buyer is a New York City centric buyer, hadn't really bought multifamily in the suburbs pre-pandemic, with capital coming from Europe, from England. So unique buyer, unique capital source, planting a flag in the suburban New York area in relatively newer product. Right? It's only 2 years old. So, and in a market that's seeing and has seen, and I think everybody knows, it's seen a lot of new construction over the last several years, and still has some deals under construction. So there's always a question when that happens about how you push rents. But what I like about it is new capital coming in, whether it's New York City money, overseas, buyers that historically have looked at different types of multifamily assets, now looking to see where they can add value. So a couple of points on this page. Let's go to the next page. So a couple interesting ones. This one, the second deal here, the Brownstones in Englewood, this just closed. And I put the metrics in here so you could see it at 130 million or so, 370 a door. The cap rate was sub 4.2. And that's a great number. That's an institutional buyer, right? That had really never owned multifamily in the suburban New York area, pre-pandemic anyway, right? Looked at a lot of assets, couldn't get to pricing pre-pandemic. Participated in auction processes that we held and just couldn't get there. And finally said, you know what? I'm willing to match the market and beat the market today, given our cost of capital and given the debt today and where we are. And they did finance it. So really good pricing, and the cap rate was, like I said, sub 4.2. Overlook at Flanders is one more to mention on this page. So larger transaction, right? Deal size is, call it, the $250 million range. Per unit feels good because you're, in the 250 range, a little better than that. An older product with a renovation play. And really what happened there, we saw a lot of private groups step up for this deal. And the cap rate was a little higher than I think, you would normally expect for this. It's also, a little further out, but cap rate was sub 5, it was in the 4s. But good activity and a good buyer pool for this, and great per unit pricing. So we're seeing kind of newer product. We've got older product. We're just seeing a lot of great activity now. Again, kind of having started in the fall into winter and now carrying over into 21. So from a multifamily perspective, the capital's there, from equity debt, the buyer pool's there, the underwriting now feels supportable. And even the newer assets that we're putting in the market are seeing good activity. So multifamily, we're bullish for the rest of 21. And I'll tell you, I think second half of 21 on the multifamily side, we're going to see a significant amount of activity coming, because there's some groups that have waited to say, you know what, I don't know if I want to go in January and February, go to market in January and February. Let's look at the spring. Let's let the rents recover, right? Let's move the rents here a little bit, right? We always see an increase in occupancy and rent growth in the spring in suburban New Jersey. And then let's talk about going to market. So I think the summer/fall is going to be very, very busy. From a brokerage side, we can only see kind of 6 months out. And I can tell you the activity level is going to increase. So I'm looking for a banner year on multifamily in New Jersey. Let's go to the next page. So we don't need to dwell too much more on multi, actually. Let's go to industrial. I want to talk a little bit about industrial. Oh, you know what? We'll do office. So let's go to the next page. So on the office side, so this has been interesting, right? I think everyone, once the pandemic hit, I think everyone was waiting on the waterfront with a catcher's mitt, waiting for all the tenants to come back, right, to New Jersey. We said it's time. We've been waiting 30 years for all the tenants to come out of New York and fill all the Jersey office buildings. And honestly, that hasn't happened, right? And I don't like to make direct comparisons to 9/11, but we saw something similar in 9/11 where we thought there was going to be a big move out of New York into the suburban markets. And we did see a couple of large leases at that point in 01. But really, everyone went back into the city. And I think in today's world, and I'm not gonna predict kind of what happens with office space. I think everyone's still trying to figure out what happens from a tenant perspective with the office space and how that use. And is there any work from home program? And is it industry by industry? Is it region by region? No one knows. But I think from what we're seeing today, and to my second bullet point here, the tenants want flexibility and their employees want flexibility. And I've been reading a lot about this recently, and just understanding now that this experiment of working from home, was met with, for the most part, some success. There were some failures and things that didn't work. And I think we all saw a lot of that. But at the same time, I think there's going to be a lot of companies that do, at this point, provide a flexible program to work from home. Now, whether the employees want to do that, whether that sentiment changes over time, no one knows. But from a use perspective, that will have an impact on not only kind of the current deals in place, right, the current leases, but also future leases. And I'm not on the leasing side, so I've exhausted my knowledge of leasing at that point. So, but taking it from an investor perspective, right, the investors, and whether they're traditional office investors or newer entrants coming into the market, they're definitely watching those trends because it impacts their occupancy, it impacts pricing, it impacts their financing. So those trends lead up to what the investors are going to do, right? And do they believe that there needs to be, or that there will be, a reduction in space? And again, it could be a reduction in space. I don't know. I'll pick an industry, the legal industry. You know, do they need to be in the office reading those contracts, or can they read from home? You could argue both sides of it. I get it. But I do think from an investor perspective, and what we're seeing now too is, you know, there is a concern, and has been a concern in New Jersey about short-term leases, right? And how do those get underwritten? How do you finance it? Do they have credit? Do they not have credit? I will say I've been very impressed and very surprised as to the pricing on longer-term credit deals, right? And we're working on a few of them right now. I'll talk about them in a minute here. But the term and credit, I talked about it when we started. Predictable cash flow, credit, you know, the ability of that tenant to manage and really minimize the impact the landlord needs to have on the asset, has seen cap rates compress there as well. We're selling a large office complex in New Jersey right now. It's a 15-year credit lease. So credit, term, location, and that's pricing in the mid fives, which I'll tell you, that's in any market, pre, post-COVID, doesn't matter. That's an aggressive cap rate, any way you look at it. So there's capital today for office in New Jersey, okay, for that term and credit. I will also say though, for well-located, good credit, shorter term space with some upside, right? We're seeing good activity there. And that's kind of the second level, right? We know where pricing is on great credit long-term leases. Now we're looking at really well-located assets, good quality, with multi-tenanted, with different terms, but still, and providing some upside, so some vacancy. But that activity is now starting to pick up. And I will say that we've seen it definitely more from the private investors, right? That's definitely been the focus for them. But I wouldn't be surprised to see some of the private investors today with some form of institutional capital. Now, do I think it's pension fund money? No. But do I think it's a private fund that I would qualify a little bit more into the institutional category than I would into the private buyer category? Yeah, I do. So just some thoughts, some themes on what we're seeing. Let's go to the next page. So just a couple of assets here. And this is a mix, right? These four are kind of a mix, right? The first three are vacant, well-located, good quality assets. And there is a demand for that. So that's the last rung on that kind of, let's call it, you know, investor index, right? Of full credit, term, location to fully vacant, right? So these three, which, you know, are being priced appropriately in these, you know, kind of sub $100 a foot range, all of them, are in a position where there are the value-add investors today who are willing to take a lease-up risk on this Roseland deal, which is a corporate seller. They no longer need the facility. Is one where the activity level is looking at it saying, all right, well, I can buy this existing office building, but I may look at a redevelopment scenario here. And whether that's multifamily, industrial, there's a lot of moving pieces to this. And the other two could possibly be redevelopment scenarios as well. So that aspect of it hasn't changed. And I'm going to talk about land a little later so you can see, but the redevelopment scenarios are out there. don't want to get sidetracked on that just yet, but I did want to mention two quick deals. We're working with two large retailers right now in New Jersey, two vacant boxes that they occupied, large, right? Each one's about 300,000 square feet, Central Jersey. And both called different retailers and said, look, we no longer need the box. And we want to bring a partner in. We want to stay in the deal, bring a partner in and redevelop these boxes. Now, they both happen to be going multifamily, but there was the opportunity to go industrial on one of them. And what does that mean? That the retailer is now partnering with the developer, going into town to get approvals to redevelop the box into multifamily. So it feels a little bit like those retailers maybe aren't as interested in selling men's shoes anymore, but are looking to get into the real estate business because there's a lot of value to the assets they own. So that I thought was interesting. And both deals are underway. Both have developers identified and both are progressing. So anyway, just a side note of some of the redevelopment of not only retail, but also these office buildings. Last one on this page, that's 7 Sylvan, a campus, great assets. We're seeing really good activity there. There's upside in the deal. This is one of those examples of quality, location, and upside, right? And we're excited about this, and we're gonna be taking bids on this soon. And the investor markets reacted pretty well to that. So let's go to the next page. So yeah, so a couple just to highlight here. I want to make sure I get through everything with the time. But so Alexander Park, Class A assets, Princeton, 90% leased, institutional owner, right? This one was awarded, and we're in due diligence and moving forward. And the good news is the pricing there, right, which is north of $200 a foot, is great for that asset class, right? So good activity, good pricing. There's vacancies, so I'm not quoting a cap rate on this one, but I like the action in Princeton. And by the way, our runner-up bidder, which I thought was interesting, private group out of New York with Middle Eastern money. So you generally don't see that in suburban Princeton, right? Overseas capital doesn't usually show up in Princeton. There's you can count them on one hand, the amount of deals that are overseas capital in Princeton. So that I thought was a pretty important point that, look, 10, 12 years ago, you wouldn't see overseas capital in New Jersey. It was really specific to New York. It wouldn't cross the Hudson. Today, though, absolutely crosses the Hudson and across product types. Retail, office, industrial, multifamily, cross product types. One other one to mention, the Summit East corporate campus. So this one, surplus real estate. I think when we originally looked at it, we thought, all right, this is a great location to be redeveloped, whether it was industrial or multi, some other product type. But the buyer here is actually keeping this office, and the town is happy about that. The seller's happy about that. So they're actually going to keep it office. And this is a play on, some potential groups coming out of New York in the long term. It's a great town, great location. You can break up the space into smaller units. They're not looking for a 300,000 square footer to come out of New York. You can go smaller here. So a lot of different plays on the office market today, but I like that deal a lot. Let's go to the next page. So these are a little older now. These are although during COVID, they closed during COVID. These were deals that were agreed to pre-COVID though. So they're technically pre-COVID pricing, even though they closed during COVID. The one to just quickly point out is 85 Challenger. So short-term lease to Samsung in the building. And we brought Asian capital over to buy that deal during COVID. The tours were challenging because of the travel restrictions, but we got through it. And I think the interesting thing there, the cap rate is, kind of sub 6, which is impressive for that term, for the remaining term on that tenant. Even though you get the credit, you really have the term there. So I think a lot of good info on that one in terms of the demand from overseas capital to be placed in the U.S. and didn't want to wait for COVID to be over. So let's move on. Industrial. Well, this is truly exciting today to watch the industrial market. And how it continues to accelerate. I'll tell you, even my first bullet point is actually already out of date. We're seeing core quality, cap rate 250 basis points above corporate bonds. No, it's probably in the, it literally could be in the 150 range now, depending on the credit. I mean, it's accelerated that much. Cap rates 3.6 to 4.25. Yes, depends on the asset. But are we seeing 3.5s? I think we're going to see some of those printed shortly. 3.5s, which shocking, right? I mean, I think, and the speed with which that got there. And honestly, I don't know that it's done coming down yet. We'll see. No one knows. We are seeing more cash deals, so less industrial financing than I think we expected, just because there's so much capital raised. Every institution is light. All the funds are still light, even though they have been loading up on it the last several years. There doesn't seem to be a let up in the demand. And that ranges from the private funds, more the opportunistic groups, the institutional, the pension funds. I mean, the demand, I can't say it enough. You read about it, you hear about it, you see it. Land pricing, I mean, we're selling covered land plays at $200 a foot plus. So, I mean, if you do the quick back of the envelope math, if you're in for 200, you're going to tear it down, build a new building, pick whatever, the $80 to $100 a foot to build it. You're in for 300, you got to get out at 350 plus. I mean, that's there's not a lot of pushback on those numbers. And I'm going to talk about one deal that we closed in Long Island in December that was a $75 million transaction, 10-year Home Depot credit, traded to an insurance company. And that pricing was a 4.1 cap at $382 a foot, which honestly, we don't, if the tenant was paying, kind of call it north of $12 a foot, if that rent was cheaper and resulting in a cheaper per square foot for that deal, the cap rate would have come down into the threes without a doubt. But because the per foot pricing was approaching 400 on the way in, if I get the call back in 3, 4, 5 years to get them out, you got to get them out at $500 a foot, which is unheard of. So there's challenges a little bit on the per foot. We're seeing a little bit more, but it's not stopping anybody, that's for sure. And just a couple quick points. I think the kind of more the niche type product, cold storage, flex, that kind of product historically had seen, 100 to 150 basis points spread between those cap rates. That is much tighter today. It's 50 to 75 basis points. It's the asset classes that qualify under industrial now, or the product types that qualify under industrial now is definitely widened and includes a lot more deals, resulting in, because you can't find as much product, compressing those cap rates. So let's go to the next page. Let me see, how much time do we have? We've got like 10 minutes, so I'm going to move this along quickly. So we've got a couple deals here to talk about, and pricing on these varies, right? And some of these are different, right? Like 950 West Fingerboard, like that's a vacant industrial building, right, on Staten Island, and the activity there, I mean, it's above where we priced it. I keep getting bids higher than where we priced it, and I'm not complaining. It's great, but it's just surprising, right? 161 Meister, great asset. We are awarding that shortly, and that pricing that's a single tenant credit deal, decent term remaining, and that's got really good activity. So that should be that'll move along. That cap rate's going to be kind of in the 4s, and I can't talk about exactly where just yet. 200 Broach Drive, this is sale leaseback, corporate sale leaseback, great credit, good location, great use. And we had 16 bids on this deal. And we had 3 rounds of bidding and an interview round with 8 bidders. No one wanted to go home. So really just strong activity on the industrial front. Let's see the next page. Anything worth mentioning? We'll move on. I want to get to retail too. So real quick, just the Lincoln Logistics at Hicksville, that's the one I mentioned, 75 million, with that cap rate in the low, almost, kind of 4 cap, so to speak, 4.1 cap, but great activity there. And we're closing this Ruffin County Light Industrial portfolio, so just about 260,000 feet. And that buyer is a private buyer with institutional capital. For, in terms of quality, honestly, it's B plus type quality in a good market, right? Not 8A or Meadowlands, Valley Cottage, New York, but to get pricing here that we saw and get institutional capital for this location and that quality just speaks to the demand today for industrial product. So just wanted to hit you with a couple data points so you can see it. Let's go to the next page. All right, retail. So the death of retail is completely overstated. I'll just make that comment. Look, we've seen great activity on, again, the credit and the term. We're closing a large deal this week, 300 million. It's 10 credit anchored shopping centers throughout the Northeast. And that pricing is a 4.3 cap, right? Which is great. That's just, I think if you had said to me at any point in the last several years, you're going to see retail trading in the sub 4.5 range, I would have said, no way, it's not happening. But that deal is closing. We just closed a deal in Bloomfield, New Jersey. I'll tell you which one it is, Home Depot, right off the Parkway. And smaller deal size, sub 20, but that deal traded at a 4.4 cap with 3 rounds of bidding. And that's a 12-year Home Depot, that multiple renewal options. But you have term, credit, location, that parking lot's always packed. And that deal's a 4.4 cap today. And we had a 1031 buyer, institutional buyer, and a private buyer. So great activity for the right retail deals. And I'll share with you also, we did just close a mall on Long Island, over 1 million square feet. And it was in I'll say disarray. I mean, occupancy down significantly, income dropped 70% at that mall. The buyer of that mall, now the underlying zoning there was industrial. The buyer of that mall, which ends up being a REIT, along with a couple of private developers, is looking at least as it is today, maybe more of a hybrid use, some additional types of uses on the site. And I thought that was interesting because we're going to see more of that for some of the retail that doesn't, right? Not every retail deal has 20 years of credit, right? But some of the retail deals, whether they're malls or other smaller retail centers that just don't work anymore, you are going to see those redeveloped. Like I mentioned, those 2 boxes that I was talking about that were owned by retailers. But the investors that are looking at some of these deals, some of these repositioning deals, I think you're going to see a lot more of that. So that's definitely underway. And then I'll tell you, now that some of these longer term credit grocery deals have traded, and we've seen cap rates there established in the 4s without a doubt. Okay, now the next wave of deals that we're seeing hit are more the traditional grocery anchor, right? Your grocer, your nail salon, fast food place, and so on and so forth. And those we're going to start bringing to market now because there are some data points nationally. The demand seems to be there as we talk to the investors, and we're actually quietly marketing one right now that's a Whole Food Center. So it does feel like, from a retail perspective, I'm not putting retail in that category of it's over. Absolutely not. Not from an investor perspective, because we're seeing the comps, we're seeing the activity, we're seeing the pricing stay strong. And yes, is it selective? Absolutely. Absolutely. But that buyer pool, I'm going to tell you, I think second half of this year, you're going to see that buyer pool expand even further. And the other reason is too, right? If you take out the kind of long-term credit leases and you just look at more traditional type returns on these assets, right? You look at retail, you look at multifamily and industrial, and they're trading in the 4s and industrial in the 3s. right? If you're looking at retail and even some office, you can get yield today. You can get office trades in this, for multi-tenant term, but not all the credit out there, but you can get those in the sevens. And retail, non-grocery, 6s to 7s. So there's a spread there, and the investors aren't going to, if you don't want to deal with a 3 or a 4 on a return, you can get that 6 and 7, and on some assets even a little better. So I'm telling you, that capital is going to start to look for a return. It has to, and whether it's second half of this year, beginning of next year, you're going to see more of that. So I'm on record. All right, let's do a couple of quick deals. Do I have any time? I'll take 1 minute. So ShopRite deal. This is a term credit deal. ShopRite Square on the left. 17 years to ShopRite. We're in the 4s on pricing there. We just put this Wegmans deal out in the market at Parsippany. That's an awesome center. That one's going to trade in the 4s as well. So just a couple of quick data points. Let's go to the next page. Land development. Let's go to the next page. I've just been surprised how much demand there's been for land. Historically, our team will take on a few land sites. As a broker, you can spend a lot of time on land and nothing happens. That's not the case this year. There is definitely a move afoot to acquire land for development, whether it's the home builders, the nationals, the local developers. And pricing has gotten stronger. I mean, we're doing even some for sale land. So condo and for sale townhomes, depending on the market. I mean, those are pricing kind of north of $200,000 a door. So really interesting, I think, today on the dirt. I was surprised to see the demand coming out of COVID, and I'll use the term coming out of COVID. I'm optimistic for those land sites today. And with 1 minute left, I'm gonna give you one other comment on hotels, because we're spending more time with our hotel team and our hotels in the suburban New York area. That's kind of Princeton, Stanford, the Meadowlands. We're working on 4 hotels, and these are some of them are struggling a little bit. So obviously we're looking at redevelopment or repositioning as potentially multifamily. And that's been a trend that continues to see. We're seeing activity there, much more opportunistic pricing. They're still recovering. That's all I got. I think I'm out of time.
Okay, Jose, thank you very much. What a great overview of where we are with the markets. We've got 2 questions. One question coming from Chris, and Chris's question is, do you anticipate a greater extent of rent control coming into New Jersey?
I mean, look, it's tough to tell. And would I anticipate it? I think it's possible, yeah. I mean, I can't predict it, but it's possible, for sure.
Okay, and the second question is really my question. The one word I did not hear you mention in the entire presentation is the word distressed. And we hear and we read about all these funds accumulating hundreds of millions of dollars, waiting for a real estate bubble to occur so that these funds can buy distressed assets at really low bottom prices with desperate sellers, I assume. Is that happening? Do you expect that to happen, or are we past that stage? What's your thoughts on that?
I thought the word you were going to say was commissions, which I thought was even more important. But anyway, but all right, let's talk distress. So yeah, we haven't seen the amount of distress. I get the calls, if not every day, every other day. Hey, what do you got? Is there any owners that we can talk to? We can provide rescue capital. How do we get into this? And yeah, we haven't seen as much distress. We're definitely pricing some deals. I will say that. And we're pricing deals on behalf of the servicers. They're calling and saying, look, whether it's a maturity default, or it's a tenant leaving, or it's a missed payment for whatever reason, right? Something else going on in their lives. There's definitely a lot of valuations, but I think the extent or the amount of distressed assets that everyone was anticipating with COVID, that hasn't been seen. And do I expect that to increase? No. Do I expect to see some hit the market? Yeah, we're working on 2 right now that we've taken to market for servicers, smaller private owners. Remember, I think pre-COVID, this is different than the recession of kind of 07, 08, 09. Everyone went into this, or a lot of groups went into this in a very strong financial position. So this did not start from a financial perspective. So now, whether it impacts to the property, for sure, personal impact, absolutely. But the amount of distress that I think came out of 08, 09 versus the amount of distress that at least we're seeing here in the New York area. And I will say there is a regional aspect to this too. There might be some more distress in the Southeast, in the Northwest, but in the New York area, the suburban New York area. And by the way, New York City is a whole other story, but in the suburban New York area, we haven't seen the amount of distress that I think right when this first happened, we expected, and nor do I see that increasing dramatically.
And the final question is coming from Peter, who snuck in the last question at the last minute. Peter wants to know, with respect to the 1031 tax law changes, what impact do you see with respect to the real estate markets?
Look, if the tax law changes, that's going to have a dramatic impact, I think. I think that's going to be significant. We do a lot of 1031 work now. And, I remember 1031s aren't tax avoidance, they're tax deferral. So at some point, you're paying the taxes. It's not that you're getting out of it. Then there's some key pieces to that too. But no, I think the answer is it's a material impact to the market for sure. And there's a lot of conversation about it underway.
Okay, we are out of time for Jose. Jose, again, thank you very much. Please, you feel free to stay for the second panel. You might have some questions for our lenders. Who knows? Okay, so let's dig a little deeper now into our real estate marketplace and speak to our real estate lenders. We have 4 very experienced, very active lenders with us today. They all will speak for a few minutes on their respective institutions in terms of what their lending criteria are. I've asked them to speak to what changes they see in our COVID environment versus what they saw, pre-COVID. They'll talk about how they're structuring deals today. They may even mention pricing. I've asked the lenders to speak in alphabetical order. So I'll introduce each one, and then we'll go into our individual presentations. First, we have Michael Claisse, Senior Vice President and Director of Commercial Real Estate Lending at Spencer Savings Bank. Michael, you could just wave your hand if you want. Then we have Peter Rand, Senior Vice President at KeyBank Real Estate Capital. We also have with us Charles Ruffin, AVP and Sales Manager at Immigrant Mortgage Company. And finally, Ken Wood, and there he is, Ken Wood, Managing Director at Verus Commercial Real Estate Finance. So we'll start off with Michael in alphabetical order. Each panelist will speak for a few minutes. Then we'll go to the audience for questions. I have some questions as well. And then we'll do a little wrap up. Michael, it's all yours.
Good morning. Can you hear me okay?
Yes.
Well, good. I'm looking at Leah. First thing I want to make one point is I am wearing green, and I don't see anybody else wearing green. So want to make that clear that Spencer has stepped up, at least there. Let's talk a little bit about Spencer first. We're over 100 years old. I think we're about the second oldest community bank in the state, and we're a mutual. So folks that don't know, that means we're not publicly traded. The owners of the bank are deposit holders. So shameless plug, feel free to come be an owner, deposit money. It's always good. Now, we have about 21 branches, just to give you a little background on us. Northern Jersey, mostly. We have one smaller branch down in Ewing. Headquarters at Elmwood Park, where I'm sitting today, not remote, so wearing pants. And we have about 300 plus employees. We're about 3.3 billion in size, lending assets about 2.5 billion. So let me tell you a little bit about me, just because I guess I'm new to New Jersey, actually. My background, I've been here about 2.5 years at Spencer. I'm a Long Island guy, so I was kind of interested when Jose was saying about some of those Long Island things. I'm really from New York money center banks. I come out of Bank of New York and Bank of America, and my background leaned, or for the last, say, 20 years was really more on the equity side of real estate. I did debt and equity for affordable housing, low-income housing tax credits, construction, things like that. So really more non-balance sheet lending. I started in Mid-Atlantic and NatWest just to show how old I am. So I have been in this arena before. And it was funny. It's a shame Jose's not on, because he made a really good point about 9/11, and part of the thing we're talking about is what's going on with New York City, to kind of skip to the side. And my address was 1 Wall Street at 9/11 and during 2008 and 9, and then even at the first Wall Street, the World Trade Center bombing. And every time there was a death blow to New York City always came back. So as much as maybe even I'm shying away at our real estate in New York City, there's no doubt it will be there. It is still New York City. So I thought Jose made a really good point about that. Now let's talk about the real estate departments. That's what we're here for. We're still lending. We have about $1.5 billion portfolio. Everything is done in-house. We have about 20 employees in real estate. It's all done here: underwriting, closing, new business development, even disbursement. There's like 19 of the 20 work, and then you have one guy who plays golf. So that works out well for at least me. So and we're busy. We're balance sheets. That means everything we do is permanent loans. If you do, we're trying to build construction. Again, my background. Our permanent loans are 5 and 10 year, 15 year, typical 25, 30 year amortization. But in our construction are conversion to perm. We don't just do one-off construction. Primary markets, obviously in New Jersey, bank. We do a lot in New York and pretty much primarily the boroughs. In Brooklyn, we're a market rate of multifamily, and in the Bronx, we tend to see a lot more affordable. We try to do not as much construction in New York. Again, we're trying to build a portfolio better off starting in Jersey. So that's where we're at there. And just for like a morphing, I said about 5 years ago, our portfolio is about 90% New Jersey, 10% New York, and we do a little bit in Pennsylvania, Philly, and very little bit in Connecticut. And so went from 90% Jersey. Today it's about 60% New Jersey. We do have to keep cognizant of the whole CRA obligation, so we can't go too strong into New York. But we're almost 60-40 split that way on those. Typical loan amounts were $1.5 million to say $25 million. We do smaller, we do bigger. We have other departments that can do some smaller things. We are a community bank, so we don't want to say no to clients. Sweet spot, I'd have to say, is probably closer to $3 to $8 million. Just that seems to be where we're at. But we've closed plenty of deals on either side of it. Types of deals, and we can, maybe I'll even skip quickly into like, say, a pre and a post pandemic. Now we're multifamily, industrial, retail, office, typical. We never did a lot of regular office. It was mostly medical office. We're continuing to do that. And again, we're doing construction. Purchases, we seem to see a lot of refis and cash out refis, and maybe because we do them more, we seem to see a lot of them. We do have certain restrictions, but it's a pretty popular part of our business. And our current portfolio is probably about 55%, 57% multifamily, with the difference being retail and commercial. So what have we done lately? That's kind of our background. We had 2019 was actually a pretty heavy year. We closed, I guess we're a smallish bank from, say, my background. We closed north of 100 plus deals each year the last couple of years. 2019, we were about 330 million. And now what's kind of interesting is that we actually had a pretty robust pipeline coming out of 2019, and we were feeling kind of cocky, and then March hit. But we did actually close about $350 million last year. We held to what we underwrote, and it goes back to a little bit my background as well, is that I came out of New York in 2000, New York 2007, 8, and 9, and I didn't change my pricing on things we previously committed to when the world ended. So we certainly didn't change things this time around either. Everybody makes their own decisions, what's best for their bank and their financial institution. So we held, for the most part, we held true to the underwriting. And then, then we basically had to shift and get a little bit more conservative. Whereas we were, in previous years, 55, 60% multifamily, the rest commercial. In 2020, we ended up being about 70% of our business was multifamily. And then actually currently we're about 76% multifamily. So we did make a cognizant decision to try to get a little bit more conservative, or at least to the properties that were doing better. Now, and I guess that I've already segued kind of into the pandemic. Our bread and butter was small retail, and like everybody had issues, and we did learn. And when markets have a hard time, you do learn from it. Who knew a government could walk in and just shut something down, whether right or wrong, it's a political thing. But you have a business and someone paying rent, nothing to do about it because they can't actually occupy. So we did pull away from, say, small retail. We never were heavy in office, but we were always heavy in medical office. And we just closed a $22 million medical office in Great Neck, New York. So we're still, medical office, we feel at least, is still doing well. The things we have, I mentioned that we kind of changed standards. We were typical like everybody else, 5% vacancy, 1.25 debt service coverage, regular loan to values, depending on the property type. But we had to kind of pull back. We pulled back on the property types. Again, we had our bigger issues were, say, the smaller retails. If we pull back that, we also pulled back on, we tightened up our standards. So, 1.20 debt service coverage on a multifamily became a 1.30. Again, and just down the line, without going into each and every property, but we simply just tightened the metrics up. But we did I think the overall thing is, while I'm saying almost the negative, is that we actually saw an opportunity here. There's always an opportunity in good times and in bad. And, coming from someone in the affordable housing arena, I certainly understand that. But even in regular real estate, just simply have to underwrite to protect the institution, and it'll be fine. But we did kind of, the one thing we did, some of it didn't see a huge amount was, online shopping and everybody staying in house just created this huge need for distribution facilities. So we saw a huge rise in, say, flex industrial and warehouse. That's hot. Personally, I think it's probably going to remain hot. Yeah, it's, the country has shifted in certain ways, and maybe it will stay that way. And again, and multifamily is fine, and we can get into I think it's an important question at some point. I like to hear other people's answers too on what happened in COVID, and when you had some issues, how did you help the folks out, or what did you do to mitigate potential problems? Personally, I think a lot of things, and again, one of those things Jose mentioned too, is once we get rid of non-eviction, I think we might be able to get a better grasp of where we are, especially on the multifamily side. You have to pay your rent, and maybe people will pay rent. I'm kind of curious what the other folks have to say about that. So, we reassessed our worlds. We had some pre-funding on principal, interest, and taxes. Again, going back to about April, May, so especially on refinances, really just to kind of get us out of what we thought was the issue. And again, people always ask me, where do you think the market's going? Well, I thought everything would be better by last August. So I don't know. We can just judge. We can judge. If I really knew, my butler would be on here talking to you guys. So that's how that would go. But really, we're no different. We're a bank. There's other institutions here. There's other people listening. And you had to figure out what the best thing to do, what's going to work, what's not going to work, what metrics you want to use. Where do you feel safe? Do you want to shut down? Do you want to slow up? We were lucky in a sense that we've always been kind of a conservative bank, and we really did see an opportunity. We're well-capitalized banks. We did see an opportunity to lend, but to lend correctly. I think we found a suitable way to do business with clients, to keep them getting their financing, to protect the bank. Time's going to tell. If I'm on this panel next year, I did good. If I'm in Key West, I didn't do so good. So we'll get that. So thanks for the time, and looking forward to hearing the other folks.
Thank you, Michael. Let's shift over to Peter Rand.
Hey, good morning. Thanks, Ron. And thanks, Michael. Peter Rand, I work with KeyBank. Part of our commercial bank is KeyBank Real Estate Capital. So that's the area where I function. My office is in New York City, but I'm remote the past year out here in New Jersey. KeyBank itself is a regional bank, so we differ from other types of bank where we cover multiple states. We're about $170 billion in assets. We have branches, a branch network of about 1,000 branches, really within about 15 states, focused in the Northeast and going across the middle of the country, Ohio, where our headquarters is in Cleveland, and then really a strong presence in the Pacific Northwest of Oregon and state of Washington and, well, Colorado, just a little bit to the east, and Alaska. So a variety of places. All in all, as I think I said, about 17,000 employees. Real estate is one of the national verticals that we have. So we lend in all 50 states. And we have within real estate capital, we have basically three groups. We have an institutional group that lends to REITs, private and public, real estate operating companies and funds. A lot of that is on the unsecured basis based on the overall health of the entity. We have a healthcare group, uses the balance sheet to lend for assisted living, congregate care, other sorts of health facilities, both on the short term using KeyBank's balance sheet, as I said, and then also utilizing the agencies for long-term permanent financing. The group that I work with is called Income Property Group. With the KeyBank funds, we have about $9 billion portfolio of lending and on the balance sheet. And that's really, we do that, and then we also have long-term permanent financing. So our target that we work with are project specific for the most part, with owner investors that have a portfolio and have additional needs, and we can follow them, whether half my business is in this region right here, or maybe half elsewhere in the country as we follow them around where they have other activities and investments. That's kind of what our focus is for there. We also work with our private bank. We work with a public finance group, which can do tax increment financings or bond financings related to credit structures or tenants that are credit that quite often developers come into play with, and our treasury management group. So, there's a number of different groups that we interface with and try and put together some solutions to our clients. In terms of property type, I'd say the predominant property type is multifamily. Probably about 60% of our portfolio is that. And we have office, retail, industrial, self-storage, other various, mixed use type categories besides that make up the rest. I think that, with all of our balance sheet lending, most of it has some modicum of recourse, partial recourse. So that's a function of our short-term lending. Now that short-term lending can anywhere be from 3 months, on a quick close that's bridging to a perm, to 3 years, let's say. So it's in the 1 to 3 year category with some extensions upon that. It's really within that grouping, and then that tenor of loan, it's floating over LIBOR currently, soon to be probably floating over SOFR as that rate changes. We aim to have about 75% of our assets that we lend on with a balance sheet being cash flowing, right? So it's quick close, bridge to perm, it's a transitional asset, some other sort of going from point A to point B before the NOI is totally mature. So that's 75%. And then about 25% will be ground up construction. So seeing that that's a smaller ratio, it's more valuable capital. It's more geared towards our relationships that we currently have, or prospects that we can work with, where we can do other things with that client, permanent financing, or deposits and operating accounts, or fintech on the automated payables, automated receivables, various things that can happen. Our pricing, as I said, it's over LIBOR, I'd say currently, but I'm probably in that range of 200 to 300 over LIBOR. LIBOR right now is like 0.11 and SOFR is 0.01. So it's almost zero at this moment. That SOFR is the standard overnight funding rate. So it's a little bit different than the LIBOR being what the bank would lend to another bank at, but just from bank to bank. So you always had that issue of perhaps something going wrong with the bank. Not that that ever happened. SOFR is the same sort of lending overnight, but it's backed by treasuries. So it's some sort of, it's a secured, it's a little bit tighter, and it's historical, and there's data points to look at as that transition happens from LIBOR to SOFR. We generally, as I said, have a partial recourse. I just want to touch on the longer term opportunities that we have on the permanent side. So as something completes construction, or somebody's buying a property or portfolio of properties or refinancing properties, that on the agency side, we work with Fannie, Freddie, and HUD. We work with, we have our own CMBS program, so we can work with CMBS, also with multifamily. We do life company placement, so we can originate that for those who prefer that type of debt. And these, of course, are non-recourse loans. So if you looked at the 10-year Treasury now being about actually jumped to 1.65 this morning, I think. So it's really doubled in within the course of a year. Granted, it dove about a year ago. CMBS rates right now are about 3.25 to 3.5 all in. Spreads CMBS are probably 1.75 to 200 over. Usually the 10-year swap. Again, it will be deal specific, property specific, cash flow specific as to the leverage points. Agencies right now, the spreads for Fannie are in that 170 to 200 range, meaning an all-in rate of like 3.3 to 3.6. Variance depend upon whether 75% financing or 65 or 55. There's different buckets that get different treatment in terms of rate. Loan size for us, I'd say our sweet spot is probably 10 to 30 million. While we do plenty of things that are 5 and up, on the perm side, probably 3 million and up. And we do work with some asset portfolios that might be a group of portfolio properties that are going to be in the 50 to 100 range also. So those things will vary. I think what I'd like to do is turn it over to Charles, and we can certainly do all sorts of discussion about what happened during COVID, and I have some thoughts on that, but I'll move it along at this point and give Charles a shot.
Okay, Charles.
Excellent. Thanks for the handoff. So again, Charles Ruffin with Immigrant Bank. So what I'll do is briefly go over a little bit of the history of Immigrant Bank, then our 3 lending platforms. So Immigrant Bank is the oldest privately owned bank in New York City. It's been around since 1850, and we're within the top, I would say, 5 largest privately owned banks in the United States. We have 3 real estate lending platforms, and the majority of the time I'll spend on the middle platform, which is Immigrant Funding Corp, because that division is unlike any other lending division dealing with commercial real estate from other banks. So the first division is our large balance division. So that's called Immigrant Realty Finance. That division is pretty much a nationwide bridge loan platform. Looking at deal sizes, 15 million plus. You can go from 15 million typically to 40, 60 million dollars as far as individually cutting a check. Or we do a lot of syndications as well too. You can go 100, 200, 300 million dollars. So that particular division is similar to other banks that might have that division, in which it's for institutional clients, debt funds, very well-heeled individuals with LIBOR-based financing for a bridge loan program. The next division is our small balance lending division. That's called Immigrant Funding Corporation. So that division looks at deal size is 10 million or less. And what makes it unique is basically we have the ability to look at deals other banks might have turned down. So it has the similarities of regular bank financing, but the ability to look at scenarios that might typically go to a bridge lender. So with that particular division, we finance, I would say 70% multifamily mixed use, remaining 30% urban office, urban retail, commercial condo, commercial co-op, underlying co-op financing, condo-act financing, and SRO financing. As far as some of the unique terms and what we basically have 5-year terms, 5 plus 5 plus 5. We have a 30-year amortization for all property types. Debt service coverage, generally 1.15, but we can go below that if we really like a deal. We also offer lines of credit for this particular platform as well. With a line of credit, we're always going to be in the first position, so we would never go in the second position behind the line of credit. As far as rates, it's for the 5-year product, you're roughly upper 3s, low 4s. But again, what makes this division unique is we can look at a loan scenario that has a story to it. Like most banks will look at deals in which you have a great sponsor with a great personal financial statement, boatload of properties to drop in their lap, no issues with the subject property. You have the best rate and the highest leverage. But these days, and with this particular division, the owner of the bank created a platform that can look at scenarios that might not fit that particular box. So it might be a borrower with a credit issue, maybe someone who has a past bankruptcy, foreclosure, technical default. Maybe the property is being delivered vacant, or the borrower might have weak tax returns because they're a real estate investor and might not show a lot. Or, it could be a entrepreneur that might not show a lot dealing with the tax returns, but they have a nice portfolio of properties. So the owner of the bank created this platform for those type of scenarios. So with that being said, we could look at and tailor-make a lending solution for deals with have those particular issues. So we're never, for this division, we're never going to be the lowest rate. We're never going to be the highest leverage. But again, with scenarios that have certain issues associated with it, a rate starting off at 3.99%, that's pretty good dealing with that particular, type of issues associated with it. As far as leverage, that's the downside. Even though we'll look at deals with quote unquote hair on it, we're not going to be highly leveraged. So for Immigrant, on a purchase request for this particular division, Immigrant Funding Corporation, we're generally roughly about 60% loan to value on a purchase request. For cash out, we're typically roughly about 50%, rate and term around 55%. But the more hair on the deal, the lower that leverage can go. Also just looking at as far as our lending territory. So this platform, unlike the large balance platform, is not a nationwide platform. It's pretty much tri-state. And I would say the bulk of where we lend is more or less in the 5 boroughs, Manhattan. We also lend in New Jersey as well too, in Southern Connecticut. Before the crisis, we were lending in the Metro Boston area and Southeast and Southwest Florida. So that's more case by case these days, but pretty much more tri-state as far as lending. As far as other attributes for this particular program, we work with a lot of mortgage brokers. I would say at least 80 to 90% of our deals come from the mortgage broker community. So we're really broker friendly as far as protecting their fee and things of that nature. Have a great compensation program for mortgage brokers. With the bank directly, we don't charge any points. There's no application fee, low closing costs. If I'm dealing with the borrower directly as well too, there's no appraisal fee. So we try and make a low cost option as far as for this particular platform. As far as closing time periods, typically, 2 to 2.5 months, what I've seen. And as far as what's going on, what's been over the last year or so, just dealing with, the effects of COVID, we have something called a COVID holdback. And that can range anywhere from, 3 months to 12 months. And what that means is we are going to collect principal, interest, tax, and insurance, and we're going to hold that aside for that particular time period. Now, I have seen individual borrowers who have a great personal financial statement in which, we would have no holdback. But in general, that amount would be held back and the mortgage payment would be deducted from it. So it's not just going to be held back in which, for a certain time period, and then after, on-time payments will be released. When that borrower closes, that borrower will not make a mortgage payment for that 3, 6, or 9 or 12 month time period. So we try and make like a win-win scenario for, the issues associated with what we have dealing with COVID. So that's on Immigrant Funding Corporation. The last division, just so you know, overall, is our residential division. So we have the standard Fannie Freddie pricing, but what makes us unique there as well, we have our program, basically a portfolio program, is basically called the cash flow program. You can use that for blanket mortgage requests. Certain times you might have owners of real estate that have 2, 3, 5, 10, for example, properties, and they just want one loan, residential loans, that is 1 to 4 family, or condos, for example, one loan on a portfolio. So you can use this for that particular platform. And it's a business purpose loan. And what also makes it unique is we don't require tax returns, bank statements. Basically, we're looking at the cash flow for the subject property to support the actual loan amount. But if it is delivered vacant, we can use market rent. And that kind of reminds me back to Immigrant Funding Corporation, another couple of attributes there. If I have a property that's delivered vacant, I can use market rent to underwrite it. So I don't have to give like a bridge loan. And then once it's leased up perm, I can go right to perm using market rent for underwriting as well too. And we're in these divisions as well, we're not a recourse, we are a recourse lender, we're not a relationship lender. So certain banks have moved in that category. So we don't require the individual borrower to move their banking relationship to immigrants. Is more transactional financing. So overall, what we tried to do, at least the owner of the bank tried to do, especially with the latter two divisions, is create a niche platform for scenarios that might not be able to fit the typical criteria for the average bank. So that's with Immigrant Funding Corporation and Immigrant Mortgage Corporation. Thank you.
Thank you, Charles. Let's move over to Ken.
Thanks, Charles and Ron. Ken Wood, Verus Cref. Verus is a private debt fund. We're a balance sheet lender. We have two lending programs. The first one is a commercial bridge loan program. It's basically for value add deals. Anything that needs, say, a lease up play, just not ready for a bank permanent finance, will do that. Our loan amounts start at 1 million and can go up to 30 million. Our rates anywhere from 7.5 to 8.5. Typically, our terms are anywhere from 12 to 24 months, and we'll do extensions if needed. Our loan to value can be up to 80% on multifamily, 75 on industrial and office, and generally 60 on retail. We're an interest-only lender. Typically, we're doing purchases, refis, again, renovations. Property types consist of multifamily, industrial, office, retail, mobile home parks, condo inventory. I'll give you a couple examples of what we did. We have a apartment deal in Mount Arlington, New Jersey. It was a newly constructed asset, but because of COVID, they stalled on their leasing and all. And the bank that they dealt with wanted them to refinance the debt. So we're refinancing it totally vacant. We're giving them a 24-month term, and we're confident that within that time, they will be able to lease it up and then take us out with either a Fannie Freddie loan or a bank loan. Another deal that we're working on is similar, where, again, another multifamily project. The borrower was with another private lender. They kind of stalled with COVID. They couldn't do any of their draw requests to upgrade the property. Hence, they couldn't improve their property. So we, again, are taking them out so that they can finish the project. Again, a 24-month term. Once completed, they'll be, again, take us out with some, hopefully either agency or bank financing. We can close in generally 30 days. So another part of our business is a deal that needs to close quickly. And again, that we can move like that. We've gotten some discounted payoff deals where, again, the bank wants it off their balance sheet, and they're willing to take a slight haircut if the borrower can close quickly. So we've done deals like that. So again, my program is more of a value add type play. Our Our second program is what's called our SFR program, Single Family Residence Program. And this is for a borrower that has a portfolio of single family properties. They actually can be up to a 10-unit multifamily. They need a minimum of 3 in their portfolio. And we will then do that on a permanent loan. Rates and our loans, we start at 500,000. We can go as high as 15 million. Our terms are 5, 7, and 10-year terms. We can do interest only, or we can do an amortization if the borrower is looking to pay down a little bit while he's going. And again, our rates in that program typically are around 4.5% to 5%. In addition to that, we have a bridge program with that program where a borrower can actually set up a line of credit with us and go out and buy individual homes or, again, small multifamilies, acquire them, put them on the line. Once they get enough individual properties, can bundle them up and then move them over to our permanent program. So again, those are the 2 programs that we have, and open it up for questions, I think would be great right now.
Okay, thank you, Ken. So let us open it up for questions. I'll start off with the first question, which is a valuation question. Given what's going on in the marketplace, given the fact that we hear all the time that asset values have been declining, notwithstanding what Jose said during the first panel, how do you each individually see? How are you able to value the assets that you're putting loans on the books today? And anyone go first. Michael, you want to start?
Sure. Yeah, that's actually a really good question. And I actually approach it a different way because, we are underwriting more conservative. So if you're reducing the NOI, you're compensating for what you think might be a lower value, at least in today's market. But I think what I'm trying to get away from is worrying about cap rates per se. I know at bank, right, you shouldn't be saying that. I'm more of a debt service coverage guy. So we're trying to almost move away from, because the values might be temporarily down now. And I don't want to kick a can down the road, but they're moving and we expect things to get better. So with us, it's really more about debt service coverage. But the short answer to the question is values are down now. We're compensating in a sense that we're looking more at the debt service coverage.
Pete, any comments?
Yeah, I think similar to what Michael's saying is, of course, when you do a loan, there's going to be an appraisal and it's going to come out with a value of some sort. That obviously we already made our judgment on our side, and we're looking for the appraisal to kind of confirm what we're underwriting. So as well as coverage, with some stressed rates you might look at to see how a property would be if rates did go up in the next 3 years or 4 years or whenever, depending on the term of the loan. We also look at debt yield. So that's just the NOI divided by the loan amount. So that in itself, especially for a value add type of deal where maybe it's a 5 to 6% current debt yield, and that's really not the best number for a long-term hold on let's say multifamily. Maybe it's going to trend to a 7 or 7.5. You can pick numbers and work with all sorts of scenarios, but that's a metric that we find is valuable. And that's something that we look at to help determine value. And lastly, I'll just throw in there, loan to cost, or does the owner have any dollars left in this project when they do this financing? Is it on the permanent financing? I think the agencies like to see at least 10% there. So, 90% loan to cost is one of the factors that metrics will look at for long-term perm loan. So there's a couple ways of looking at things to quantify how you approach value. And it's not just strictly LTV and appraisal.
Charles or Ken, any comments?
Yeah, sure. So again, just what Michael and Peter mentioned, all of that's taken into consideration. But what we try and do, since we look at a lot of Harrier type of transactions, do a lot of leg work up front, and sometimes, or a lot of times, dealing with the broker or the borrower directly, they don't have adequate expectations of where the value is. They're way above where the market currently is, especially like in the Manhattan market. So, it's a dramatic drop as far as in rent and things of that nature that's being received. So we just try and give an overall view of a lot of legwork ahead of time. So before we issue that term sheet, we're kind of on the same page with the borrower, with the broker, because I deal primarily with a lot of brokers, to make sure once we get that appraisal, it isn't an aha moment and the deal just blows up. But I think the best way to do it is to more or less do a lot of legwork up front, which is all the metrics is available, just to make sure the deal makes sense where it will come out to appraisal wise. And also what I like to do is if there's any scenario, because we're not a highly leveraged lender, in which I think, they are going to like the top portion of what our comfort levels leverage, is there any additional collateral? So just say if it's a purchase deal and that borrower needs exactly 60%, which is the top of our leverage. Well, if it doesn't come out to that particular appraisal amount, what compensating factors do you have? Another residential property, another commercial property, it's not highly leveraged, or it has no debt on it. I mean, I can even use a person's home actually to add into the mix with a blanket loan to make the deal work. So I try to have a more or less make sure I'm on the same page with the borrower, the broker ahead of time. And if they are at the higher leverage, just to make sure there's compensating factors so the deal still can go through.
Charles, I want to jump to this next question for you because you're the only one who mentioned this magic COVID holdback. I haven't heard that one. My question is, have you had any pushback from any of your borrowers or clients with respect to the so-called reserve?
Tremendous pushback. So unfortunately, but you have to really look at where predominantly we lend in the boroughs and especially in Manhattan. And just dealing with the issue of forbearance requests, which we had a ton of them in the beginning of, COVID, and just certain borrowers still having that problem as well too, because Manhattan is totally different as far as the boroughs as well too, even like Long Island, in which if you're in Manhattan, even like Midtown, you walk in, a lot of times it's not a lot of traffic or you have a lot of retail boarded up areas. So how do you make a lender feel comfortable, especially like what we do? We're a lender that looks at deals outside of the box. So this is a way to allow that borrower to receive financing, long-term financing, not charged without being charged any points, application fee, and a lot of times no appraisal fee. So that's how we feel comfortable. That's how the underwriter feels comfortable. And that's how the owner of the bank feels comfortable being able to lend in this environment with not a cookie cutter scenario. And again, if I have a really strong borrower, but maybe the issue might be something that, we still feel comfortable with, we might not have that COVID holdback. But certain borrowers are more real estate rich and they might not have a lot of liquidity. So we have to make that underwriter, the owner of the bank, feel comfortable. This is one of the main ways we have been able to do that. And keep in mind, with that holdback, it's not just being held separately. It will be applied to the borrower's mortgage payment. So just say if it's just 6 months, month number 7, then the borrower's making their own out-of-pocket payment. So it's like a win-win scenario for all those who are involved. But it can be a difficult and touchy subject, to say the least.
Ken, you mentioned fractured condo investing, and that struck a chord with one of our attendees. And the example the attendee gives is, suppose you have a 100-unit condo project and you have an investor who wants to buy 10% of those units. How do you structure that kind of deal?
So unfortunately, they would have to control the homeowners association. Okay. So they need to own 51%. But as long as they own that, we can lend on that in 2 ways. We can do it A, as a rental, or B, if the play is to sell the condos on an individual basis, we can structure that loan, and as they sell the units, pay them down. But again, he would have to control the homeowners association.
Okay, that's thank you for clarifying that. One of the terms that hasn't been mentioned, given the fact that we're in a COVID environment, is non-performing loans. So I just wanted to ask each of you real quick, do you have any non-performing loans in your portfolio? And if you do, what is the bank doing with them? let's see if we can narrow this into a 2 or 3 minute conversation because we're running out of time.
Sure.
I'll give you a quick answer. I don't know what that means. Never heard of non-performing loans. So that being said, the immediate thing after the COVID occurred was to look and see where are the liabilities likely, what loans might have an issue, do a deep dive, understand what the metrics are. I think there was a guidance from the OCC to just say, look, 90 days, you don't have to harshly revise ratings and risk ratings for loans immediately. As we approach now, you have to kind of take an honest look at it is where it is. And we're lucky in that, the level of non-performing loans, I think, is very limited. And those may have temporary stresses on them. So I don't think, and I think banks as a whole, I think yesterday, day before Wall Street Journal cover page was that banks are releasing some of their reserves because they don't believe things are going to be as disastrous, not wood, as was thought. So I'll stop on that point.
As far as with Immigrant, I typically get the call at least once a week as far as do we have any non-performing loans to sell. So, and we don't sell any of our loans. I've been with the bank roughly 11 years, haven't sold any loans. What typically happens is our leverage is not that high anyway. We're always able to be taken out by another entity, another bridge loan lender typically would take out our loan. So that's that particular issue. And also just dealing with what's going on during COVID, we've been, more than gracious to give like forbearance requests or, as far as approvals to individuals who are having a hard time currently, because, like was mentioned before, Manhattan market, the 5 boroughs, is like very, very unique compared to a lot of other places throughout the United States on how hard we were hit dealing with COVID. But that's how we try and deal with those scenarios to work with the sponsor. But certain times, they might not have the capabilities, but usually before it goes too far, we're taken out by a private lender because of our leverage not being that high.
With us, because we're doing more transition renovation loans, most of our clients, they couldn't finish their project during COVID because they couldn't get contractors and all out to the site. So it wasn't their fault, and we had already had interest reserve set up with them. So really all we had to do was extend it and continue to set up a interest reserve with them. And most of ours are back on track now. Again, though, the proof is when they finish the project and are able to take us out with a perm loan.
Okay, I'm going to ask the last question since we're running out of time. And Pete kind of referenced interest rates, which is obviously a hot topic in everyone's mind. Where do you guys think rates are going to be at year end? And you can reference it, whether it's LIBOR, Treasury, whatever you want to use.
I'll go first so I can say the least, because, the problem is we were kind of hoping rates would stay or go down, but everything's going up as we're seeing with the treasuries and the Fed funds. I'm not even gonna give an answer because I'm just simply not smart enough. I just hope my people can pay their debts back. I'll let the other guys take the chance on that.
I'll make myself look dumb in 9 months or so. Look, Fed has said that they want to have short-term rates being low for an extended period of time, possibly to 23. That means if you're looking at SOFR, let's say, but SOFR and LIBOR are within 10 basis points. So you're looking at a rate of like 0.1, and then you put a spread on top of that. If it's a bank lending, call it all-in rates are 2.5 to 3, or maybe less, depending on the structure and so on. But the real thing here is what is your long-term permanent underwriting rate for the exit of a short-term loan? And that is what's happening. You saw treasuries jump from 1% a month ago now to 1.65%. And, we're spending $1.9 trillion. What will that mean ultimately, in terms of just will inflation come back? Nobody knows, but that's where the guess is. I think some surveys of economists are saying the 10-year treasury will be below 2 at the end of the year, but above where it is now. Who knows?
Charles, you have a magic ball?
Of course, I think I'll have to borrow Peter's because he did a great job regarding his analysis of it. I don't really have a specific number, but you can definitely see the writing on the wall that it will be higher. So yeah, that's my viewpoint of it, but no specific number, but definitely higher.
Okay, well, with that, I want to thank Michael, Ken, Peter, Charles, and Jose for a great discussion and conversation about the overall real estate markets. I'm sure 30, 60 days now, things are going to change again. And unfortunately, that's the way the markets work. So I want to certainly thank these gentlemen for their sponsorships, because without that, we would not be able to put this program on today for our attendees. Also, I definitely want to thank Leah and the Mid-Atlantic Real Estate Journal for their assistance and their cooperation and their great technology in making sure that we didn't have any blowouts with respect to the technology. Leah, you have any last words?
So thank you all the speakers and the attendees. Hope
Okay.
everyone has a great day.
Thank you, everybody. All right, have a good day. Bye-bye.
Thank you.